As if Bank of America wasn't big enough, now the mega bank is going to be jumping into short-term payday loans. Hi everybody, JJ here. You're watching Bull Boom Bear Bust. It is Sunday. We've got a lot of news to cover. We're going to kind of do a recap of what's been happening here over the past few weeks and what we might expect here coming up in the short term and the longer term as this economy has been propped up by massive amounts of money creation, the Fed's balance sheet exploding. As we talked about a few reports ago, the number of dollars in existence has increased by 25% nearly since the shutdown that began March of 2020. Absolute insane amount of market propping when you look at the stock market, the housing market. The banks continue to lend, and now this latest here, Bank of America looking to cut into the profits of some of these payday lenders. And this is out of AmericanBanker.com. Excerpt from the article. Bank of America plans to offer some of its customers access to short-term loans in the latest blow to the payday lending industry. Now, we've talked about these payday lenders, and payday loans are a very dangerous way to try to keep your head above water because they charge just enormous amounts of interest. In some cases, it's hundreds of percent of interest. And that's why they're smaller loans, and the goal is to pay those back as quick as possible if you ever find yourself in that position. I hope you never do. I hope none of my viewers ever have to resort to payday lenders, but Bank of America is only charging a $5 fee for this short-term $500 loan. So it's meant to be just something to get people by the week, maybe a few days until they get paid, as a last resort emergency solution. But this article goes on to say it talks about some statistics that we've talked about here many times. It says here, even before the pandemic, about 40% of U.S. adults said they would struggle to pay for an unexpected $400 expense, such as a car repair, small medical bill, etc. And it was statistics like that and information like that that led us to believe that, this economy was in big trouble even before the shutdown. Of course, the shutdown came in, businesses closed, people losing their jobs. That came in and kind of stole the spotlight, so to speak, as far as the reason for the economic decline. But we know that Americans in general were in pretty big trouble before the shutdown, with most people living paycheck to paycheck, most people in some sort of debt, while at the same time the cost of living continues to rise. Which is a dangerous combination. Rising prices with a population that's barely skating by and having to go into debt just to keep their head above water. It's a dangerous combination. But it's been happening for so many years now that people just accept it as the new normal, being in debt. Now, speaking of propped up markets, let's talk about the stock market, and specifically Goldman Sachs. Recently found guilty to charges, and this was due to a scandal over in the bank's Malaysia division. And this should be no surprise. We do see banks doing a lot of bad things, and the fines that they get are typically a fraction of how much they actually made from these fraudulent transactions. Now, without getting into too much into the scandal, because you can read about it, here's the thing that should open a lot of people's eyes. Even after Goldman Sachs has found guilty, the stock is still increased. And this is a image out of WallStreetOnParade.com on October 22nd, 2020, the day Goldman Sachs was criminally charged by the Justice Department over the 1MDB matter. Its stock price closed up $2.49. All right, just one of many examples of how irrational this market is. But I think the time is coming near where we're going to see some reality injected back into these markets. As soon as the propping is pulled back, that's when there's going to be a very harsh economic reality that's going to slap a lot of people in the face if you're not prepared. And I think the housing market is going to be no exception. This is a tweet here out of Bill Wendell at Real Estate Cafe. He says, agents debate, quote, is this housing boom, hashtag housing bubble, or what? History will ask, what were home buyers thinking? What is it like for real estate agents to know what they knew when they asked clients to sign waivers about adverse consequences? right? So the mania is so big right now in the housing market. We have multiple offer situations, bidding wars happening almost like it was the 2006, 2007 period before the big financial crisis. And we know the banks are still lending, even though we have about 6 million people right now not able to make their housing payments. That's when you combine rent and mortgages. So typically in this sort of environment, banks should not be lending. They should be bracing for losses. But we have seen the propping up of the banking system. The Fed now moved in with the Treasury and basically combined to allow more fluid decision making as far as keeping the banks propped up. And real estate agents actually have been using a waiver form here, which includes signing a disclosure for certain situations. Let's just zoom into this here. So if we look at this form right here, the agents want you to check off and sign that you understand the following risks. The top one here, the offer price is higher than the listing price. And the question is, will these pandemic buyers be sorry in the very near future for the purchase they made during the peak of a housing bubble? Well, we'll have to wait. We'll have to see how much further the market propping goes. But with less than 3 months to go in the year of 2020 and the very important events happening November of this year, I think we're very likely to see some major corrections happening in the very near future. Okay, on the same topic of the housing bubble, let's go back to Twitter here. PNW Emergency tweeted out the following: if you're insane enough to buy during a global pandemic while rent is falling, home prices generally follow rent. Buckle up. Everyone that bought in the last year is going to be in need of a life vest shortly. Recession, housing bubble, Seattle bubble, real estate. And speaking of high home prices in Seattle, this is out of SeattlePI.com. How long people in Seattle need to save to buy a home, and this has to do with millennials at their current income levels saving up enough for a down payment on a home. And millennials hoping to buy a home now have to save for 16 years in order to afford a down payment on a home. All right, so this is, again, it's not going to end well, and I think most of you know this by now. But who is buying these homes? We know a lot of people panic bought because they moved out of the cities because of the pandemic and the work at home opportunities. A lot of people escaping the cities because of the unrest. We see ultra low mortgage rates. But back on the topic of Seattle here, a 20% average down payment comes in at $130,000. You keep the banks lending and prices will continue to climb. You pull back on the lending and the pull back on the ability for people to borrow money and prices fall. It's pretty simple. Bottom line, banks are still lending. Debt continues to increase, including mortgage debt. The average American now has $90,000 in debt. Thanks for watching this report. We're going to wrap it up, everybody. Thanks for watching. Stay well, stay prepared, stay safe. Until next time, peace.